Did the Fed cause the major collateral shortage in the banking system just so it could solve that problem? And did the Fed do something recently that's going to make the collateral shortage even worse? And are consumers going to come back and spend in a big way, or is a rug about to get pulled out from underneath the economy? Answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. We're going to dig even deeper into this collateral shortage issue because the Fed has taken it to a new level, perhaps a level that we could not conceive of how bad this thing can possibly get. And does it even matter? Maybe it doesn't. Maybe the Fed thinks this isn't a big deal. Let's go back and look into even deeper because you've sent in a bunch of questions about this. And we're going deeper into the collateral shortage today. Let's start out with the major issue, and that is there is a problem in this reverse repo market. Now, we're not at all-time high levels today. It backed off a little bit, but you'll notice today $770.83 billion of cash was swapped in an overnight or for the weekend with the Fed for collateral or Treasury securities. Now, you've heard myself, Jeff Snyder, and other people talk about how there is a major collateral shortage in the banking system. And what we're seeing it is in the T-bill market. So the natural assumption here is, well, the Fed must be lending out T-bills through this overnight repo program. And that's not exactly how it works. Because I want to show you something. Now, when you look at the operation here, it says collateral type is Treasury. It doesn't say Treasury bills, doesn't say Treasury notes, and doesn't say Treasury bonds. In fact, there are no operational details beyond the fact that the collateral is Treasury. Now, you can go to the Fed's balance sheet, the H.4.1, and you can find that, well, the Fed only has $326 billion of Treasury bills, so the banks need bills, and there's 700 and some odd or 800 billion of overnight repos, there's a problem. But overall, the Fed has $5.158 trillion of Treasury securities. So what's really going on here is this isn't a problem for the Fed. The Fed has a $5.1 billion solution, do something that's or 5.1 to $5.2 trillion solution to something that's a $700 to $800 billion problem at the moment. But you might be wondering, how is it, if there's a T-bill shortage, that the Fed can get away with this? Well, I want you to, again, let's look at the details of what we're given. And the collateral type is Treasury. It doesn't stipulate which type of Treasury. And I want you to think of it like this. Let's say you're going to go rent a car. Now, what is the life expectancy of a car? And honestly, I don't know, but we'll just pretend it's 12 years before. We'll just say a car is expected to last 12 years before it's completely worn out and needs to be replaced. Now, when you go and rent one, and let's say you rent it for 1 day, how long does that car need to function for 1 day? How long do you have it on your balance sheet for? 1 day. Does it matter if the car is brand new, 5 years old, 10 years old, or this is the last rental it'll ever see? It doesn't matter, because from your perspective, it's 1 day. And so if you think about it from the Fed's perspective, if they lend a bank who needs overnight Treasury securities, a 30-year Treasury bond, but it's for 1 night, what does the bank have it for? 1 night. And that is how you take a Treasury security of any duration and turn it into an overnight asset. You do it through the reverse repo program. And that is why there are no operational details on it, because there's none needed. It doesn't matter what the Fed is giving them. You have to think of it as an accounting switch. It's a liability swap. Let me say that again. It's a liability swap. What the banks have is too much cash. Now, you're also hearing that the banks are swapping bank reserves. And I want to clarify that because I think there's some confusion with this term. There are people that believe the term reserves, bank reserves, also implies that it means reserve assets or the byproduct of quantitative easing. Now, we know that's not the case because the quantitative easing reserve assets are held by the Fed at a Federal Reserve member bank. We know that for a fact, But let's look at the FAQ on the reverse repo to maybe get some more color here to what's really going on. And you can see right here, but the transaction, this is referring to the reverse repo program, shifts some of the liabilities on the Federal Reserve's balance sheet from deposits, keyword deposits, held by depository institutions, which would be banks, also known as bank reserves. So the Fed is using the term bank reserves interchangeably with deposits or cash to reverse repos while the trade is outstanding. So you should not assume the term bank reserves implies reserve assets from the Fed. It doesn't. It refers to as deposits held by depository institutions, and a reserve asset is not a deposit held by a depository institution. So that's one big thing we need to understand. So how does this liability swap work? Well, a deposit at a bank is a liability to the bank because a customer can walk in at any time and demand that money, and the bank needs to pay it. So it is a liability to the bank. Now, they're swapping that with the Fed, who's giving them a Treasury security for one night. Now, who is a liability of the Treasury security to? Who is that? Now, if you said the Fed, that's not true. The liability of Treasury security goes to the U.S. government. So all you're doing here is a liability swap. Liability of the bank, liability of the government. And there's a reason for this, because due to the Basel III banking regulations, now I realize what I'm about to tell you does not make any sense at all, but the banking regulations penalize banks for having too much in customer deposits. I know if you think, well, that doesn't make any sense, you're right, it doesn't. But it does, because that's what the regulations penalize the banks for. So if you're a bank and your deposits are going up, 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 and up because the government's doing a whole lot of stimulus and other government transfers, and you get penalized for it, what is your incentive to do? Get those deposits somewhere else. Get rid of them. So what would you do? How do you discourage people from depositing money at your bank? Oh yeah, you lower deposit rates. You go as close to zero, and then eventually go negative. Well, we don't want negative rates. Fed doesn't want negative rates, so they have to stabilize them through this reverse repo process. So how do you take this problem, these liabilities sitting on a bank's balance sheet that are penalizing them, and make them disappear? In fact, how do you not only make them disappear, but you give the banks a different liability, one that they can use, in a sense, because it doesn't penalize them. You give them a liability of the U.S. government. So you do that swap overnight, no big deal. And again, because the Fed has a $5.1 trillion solution to the $700 to $800 billion problem. That's why at the last FOMC meeting, you did not hear Fed Chairman Powell make any comment about, hey, this reverse repo problem's an issue and we got to deal with it. No worries. Hey, $5.1 trillion of solutions to a $700 to $800 billion problem. But it's about to get worse. How is that? Well, the banks had their stress test this recently, and of course, they passed it. Now, they don't always pass it, but it's an open book test. And let me show you from the Federal Reserve's website here. Federal Reserve Board releases results of annual bank stress test, which showed that the large banks continue to have strong capital levels and could continue lending to households and businesses during a severe recession. Could, the keyword could, continue lending. Well, probably not going to during a severe recession, but could. And what's interesting about this is once this stress test is passed, it opens the door for the banks to now increase their share buyback programs, which they're planning on. We haven't heard any formal announcements, but we know they're going to happen. And what that means is the banks are going to take some of their cash and return to their shareholders from either dividends or outright share repurchases, which means the banks are going to shrink, which means all of this cash from customer deposits is going to further penalize the banks, meaning they're going to have to swap that liability through the reverse repo program at an even greater level. Now, this also begs a question of why are we seeing 4 and 8 week Treasury bill auctions printing at or near or below 0.05%, which is what the Fed is paying on this overnight repo. So the way the repo works is the Fed gets the cash, swaps Treasury securities, And then the next day, the Fed gives the cash back, and then a tiny, tiny bit more because the interest is 0.05% per year. So the Fed actually pays the banks to do this swap. Not a lot, but a little. So you would think that this would put a floor on T-bills, right? They would all just jump up to 0.05%, maybe even higher. But why isn't that happening? Well, there's a very simple reason it's not happening. It's because the Fed has not said how long they're going to do this for. And so the banks still need T-bills to fix the problem. And they have to go out and buy them, even if it means paying more than they could get from the reverse repo program. So now that we understand what's really going on here, and that the Fed can effectively run this indefinitely, from the Fed's perspective, this is not an issue. In fact, if this was the only issue the Fed ever had to deal with, they're more than well equipped to deal with this. But did they cause it? Well, that's a good question. So let's take a look here. This is a chart of the overnight repurchase agreements in blue and 30-year Treasury yields, because there's one interesting relationship here. As you see this overnight repo program go up, you can see that it starts to put downward pressure on Treasury yields. That's kind of interesting. And then as the overnight repo problem goes away, yields went up until financial conditions started to tighten and they went down, down, down. And then we see that there's a spike in the overnight repo here in blue, drove yields down. And now we're seeing a spike in overnight repo and we're seeing downward pressure on yields. So, is this the Fed's kind of backdoor way to maybe get yields to go lower? Well, let's do a little bit more digging, because the Treasury General account, which is the checking account of the federal government, is playing a small role here because it's eradicating this pristine capital of T-bills as it unwinds its balance sheet. Now remember, Steve Van Metre borrowed a ton of money in T-bills backed underneath the CARES Act because he was allowed to, and yields on T-bills briefly dipped negative. So it made sense to borrow as much money as possible, and he did. But now they have to unwind that and bring that. We've talked about how they're going to bring it down to about $350 billion, and that's going to get rid of a lot of these T-bills, which the banks are looking for. So we know that's going to put upward pressure on the reverse repo, in addition to the banks who will likely soon start buying more of their stock back. That will put further upward pressure on the reverse repo. But let's dig a little bit deeper, because those two alone aren't explaining everything. The answer seems to be in lies with quantitative easing. Now, we could see the byproduct of quantitative easing in the monetary base, which is mostly made up of those reserve assets, the byproduct created from the quantitative easing swap. So let's overlay the monetary base. Keep in mind it is behind by 1 month against the overnight repo, and see if we can see a problem. And here we can kind of see that the repo problem starts here, and then as the Fed does more, expands its balance sheet a bit, it still persists. And then as the Fed's balance sheet starts to go down, notice how the reverse repo problem goes away. So as the Fed, think about this, pulls collateral out of the market, because what is quantitative easing do? It buys, right now, Treasury notes and bonds. So it's pulling them off the market. It's creating a collateral shortage in itself. Isn't that interesting? I know some of you saying, well, you said that for a long time, just in different words. Yes, I have. So let's go back and look. And here we see the QE, the monetary base, go up. And look what happens. Boom, there is a spike in the overnight repo, as if there's this mysterious collateral shortage that shows up. And then the collateral shortage goes away. Why does it go away? Oh, because the government is sitting on all these T-bills, and the banks creates all these T-bills to borrow all this money, so the banks have the collateral they need. Makes perfect sense, right? Now, as the TGA is being unwound, because it has to, as the provision in the CARES Act that allowed them to bring the balance up goes away, and they have to bring it down, guess what happens to the overnight repo? And you can see it spikes almost right around the same time those T-bills go away. And so what the Fed's going to do is continue to increase its balance sheet via the monetary base, further exacerbating the collateral shortage. So yes, in a sense, the Fed is trying to fight the problem that it is in part largely creating. Now, it didn't create all of it because it had nothing to do with Mnuchin borrowing all this money during the pandemic. But once that all is cleared away, there's only one person left to blame. and that is the Fed. And of course, with that, how do we know that this is going to continue to put downward pressure on yields? Because we can go back and say, well, we know that this overnight repo right here is putting downward pressure on yields. We see that it's happened before. We see that it's happening now. But again, what happens when you overlay the monetary base, except this time I put a minus sign in front of it so I can invert it. What it tells you is the Fed pulls collateral off the market, it puts downward pressure on yields. Really, the answer always comes back to the Fed. So if you've ever wondered how it is, I believe that interest rates are going to continue to go down despite no matter how many people sell or short the Treasury market, it's because the Fed's QE program is designed to put downward pressure on yields. And when you combine it with this overnight repo mess, you get a whole lot of downward pressure on yields. All right, let's take a look at the economic data as we go in to answer some of the other questions from today's show. And let's start with the core durable goods new orders. Missing expectations slightly. It was still a nice number, plus 2.3%, better than the minus 0.8 from last month. Now, again, this is May. We should expect this to slow down as demand goes down. And core durable goods, excluding food and energy, only went up 0.3. So you can see a lot of this demand actually turned out to be from aircraft and other things like that. So let's take a look at a chart, and you can see that the durable goods new orders are, I'm going to cancel out this outline piece here, are back near their 2019 highs. Is that going to hold? Well, probably not. Because let's take a look at the unemployment data. And initial claims went up. They went down slightly, but I was looking right here at the 407. They still remain about 400, which is about double what you expect during a healthy economy. So we're at 418, 411, not what you really want to see. And this doesn't make any sense because we've had now 3 states fall off the pandemic claims since last week, and 3,700 people added to the pandemic unemployment assistance. So total now virtually unchanged of 14.8 million Americans still on unemployment benefits. And next week's report should show 5 more states now falling off. This number should be dropping, and you'd think this number should be too. So it's telling you that there's something wrong in the economy. Despite employers' demand for workers, there's still layoffs going. So it's almost like people are going back to work and they're finding out there isn't a lot of demand and employers are sending people back home. The dangerous part about this is without all the assistance from the government transfers as it goes away, what direction do you likely think demand is going to go? Well, let's take a look at that next because we've got that as well. And let's move on into, let's see, here's a 4-week, 4-week bill, 0.045, 8 weeks, 0.05. I mean, again, you think these numbers would be pegged at least at 0.05, but there's a demand there, again, because nobody knows how long the Fed's going to hold the overnight repo rate at 0.05%. The Kansas City Fed Manufacturing Index expanded at about the same rate as it did in May, so that's a good sign for the manufacturing sector in Kansas City. 7-year note auction went off without a hitch. Everyone's been expecting another dismal auction, but this one actually went pretty good, so that's good news. And how about in Japan? A bit of inflation as the core CPI moves from negative 0.2 to 0, and the regular CPI in Tokyo moves from negative 0.4 to 0. So year over year unchanged, but is an inflationary move from the month before. Let's go on into today's data. We've got the personal consumption expenditure index up 0.4%, and bringing the year over year to 3.9, stripping out food and energy. Now, this is what the Fed looks at, the core. Stripping out food and energy up 0.5%. The year over year at 3.4, which looks something like this. Now, remember, we talked about on Wednesday's show how the expectation is this is going to come back down, and the Fed thinks it's going to be somewhere in this 1.3 to 1.5% range. Let's move on to, personal incomes down 2%. Do you think this number is going to keep going down? Yes, especially without government transfers. Personal spending was flat in May, and so we'll expect those numbers to keep going down in June. And inflation-adjusted consumption down 0.4%. Again, expecting that number to continue to go down. But let's look at consumer confidence, because it actually kind of went up, but it's down slightly from its preliminary, but up from last month. Consumer sentiment up, current conditions, expectations are all up. And check this out, inflation expectations went down a little bit, as did 5-year. But looking more into the details, buying conditions for houses down, vehicles down, large durable goods down. So is the consumer showing signs of coming back? No. And you're talking buying conditions that you haven't seen since the 1980s. So this is dangerous. So as we see more of this government transfers go away, demand for goods and services are going to fall, and there goes the rug underneath the economy. How about the housing market? Home buying sentiment is, well, somewhere back before 1990. Home builders remain bullish. So if you were bullish on the housing market, this is what matters: is, are people going to buy? If you're sitting on the sidelines, you need to be smiling, because this is what you want to see. If you want to see housing prices come down, you want to see home buyer sentiment stay down, so housing prices come down. Now let's take a look at the banking credit data, because, well, there's some really interesting stuff here. And we saw bank credit contract 28 billion, securities and bank credit up 6. Notably, there wasn't much purchasing in the securities and non-MBS banks. Again, the belief now is banks are going to dump Treasury securities, but they were unchanged last week. And let's say it, the banks already know the answer to the test, and they probably called their friends and asked them how they did. So they already knew the answer, but no dumping Treasury securities, at least from last week. Let's move down to the rest of the data. We have loans and leases, all commercial banks down a whopping 34 billion. That's not inflationary. How about commercial industrial loans? Down 49 billion. Real estate loans, not picking up the slack here, up 6 billion. Consumers up 2 billion in lending, not much of there. Where's all this coming from? How about cash assets and banks? That was up $71 billion. So what you can very well see here is a further contraction in lending, lower yields. Everything's telling you the financial conditions are tightening, things are about to get worse. But now you know the Fed's out fighting the fire that it started, of all things. I mean, who could believe this stuff? Well, I mean, that's why we do this show, and I appreciate you being fans. For those who watch Sunday Night Chart Show, we'll see you then. If not, we'll be back on Monday for the macro show. Have a great weekend. Bye now. The content of this video provides educational information only and is not intended to provide investment or advice. This shows not to be construed as a recommendation or solicitation by a security, finance product, instrument, or to participate in particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the validness of Advise Inc. or Steven Van Metre Financial.